So today's Ask the Expert, we are talking all things mortgage. I'm here today with Todd Nunis at Cherry Creek Mortgage. Thanks for coming by, Todd.
Happy to be here.
So we have lots of questions that I get all the time related to mortgages. So I thought it would be great to have this time that you and I you could answer some questions. We get a lot of common things. But first, tell everybody how long you've been in the mortgage business.
Too long. I've been probably doing this about 19 years now.
A long time.
It's probably, I was in Nestle Waters for 13 years, and I thought that was a long time. But I guess I'm a mortgage guy, not a water guy anymore.
You are. Yeah. You are definitely now a mortgage guy, in my book anyway. That would qualify. So we're here at Cherry Creek Mortgage. Tell us a little about Cherry Creek.
Cherry Creek is, we're the only branch in the Dallas-Fort Worth area, but they're out of Denver. They've been around 32 years. We're a mortgage banker, which means that we lend our own money, and everything happens in-house. So we process our own loans, we underwrite our own loans, we close with our own money, and we our closers. You work with the title companies and we close our own loans.
Okay, great. Yeah. Now, even though you're here in the Metroplex, can you service loans anywhere in Texas?
Anywhere in Texas, and actually I'm licensed in about 13 different states. So
okay.
I can help elsewhere, but anywhere in Texas, as long as you're licensed in the state, you can do loans anywhere in the state that you're licensed in.
Okay, great. So if we have somebody here in the Metroplex who's moving somewhere else.
Happens all the time.
Happens all the time.
Yeah.
Okay, great. So Todd, you, being in the business for 19 years, you know what is going on right now in this craziness.
It's a little nuts, right?
It's a little nuts for all of us. So tell us, on the real estate side, realtors, we're dealing with multiple offer situation. I do a lot of listings, the last one I just put on the market, we had 36 offers.
Yep.
Yes. So I am looking through 36 offers, and the ones that have some sort of financing, then I'm looking at what letter the lender or the mortgage lender has put together.
Right.
And I see all kinds of things. So I get really excited when I see that there's someone who is essentially fully underwritten on the front end.
Right.
So can you explain to everybody how you guys are approaching it and what you're doing to help buyers stand out amongst everybody else?
I think this market is, first of all, I think everybody's working harder than they've ever worked. Even if you're on the buy side and you say, hey, I've got 36 offers, you still got to go through them. You still got to educate your client on what those are. And if you're a buyer, you're putting in multiple offers and you might not get them. So, I respect what's going on, and it's a crazy world right now. I think in this market, there's plenty of deals that are still closing, but you do have to find a point of difference.
Right.
And you've got to do things that help your buyers succeed in that piece. And one of the things that we're doing is we're fast-tracking borrowers. So we're getting them fully approved through underwriting, credit, income, and assets completely reviewed. And that way, when they go to make an offer, all we really need is appraisal and title work.
Okay.
We don't need anything else.
All right.
Also, on that third-party finance addendum, they can check that box that says that it's not contingent on mortgage approval, because they've already been approved.
Okay. So just to reiterate what you said and how significant that is, that's like gold almost. You're putting the stamp, the seal of approval on a prospective buyer, and you're saying we've done everything we need to do except for the appraisal, which you have to have.
Right.
And you can't do an appraisal till after you have a contract, right? So essentially, you're having 0 days on the third party financing because you've already done the work up front. So, when I see a letter like that, I get really excited because next to cash, that's as good as gold.
Absolutely.
Okay.
And then the other thing that probably, and I think, a lot of good mortgage professionals are doing this right now, they're actually calling the seller's agents proactively. They're not waiting for the seller's agent to call them. They're actually, when the offer goes over, I'm copied on most of the offers from my agents, and I make a phone call saying, hey, I'm available if you want to chat, or I leave a little bit of a message on, if they're fast-tracked and ready to go. Because people still get the paper, but they might not understand completely what that means.
Exactly.
Right. So that little extra step will put your buyers in a better place as well.
That's awesome. That's really important. So another thing, especially now, I guess, so I get a lot of questions from all types of buyers and sellers. But on the buyer side, especially if they're a first-time buyer or they haven't done it in a long time, you hear about all these different types of loan products out there, and to them, it's kind of like alphabet soup. Like, what the heck is this? And I'm not the expert, you are. So one of the main ones is like, what everybody knows what VA is, right? Because that's somebody who has been served in the military.
Sure.
They have VA loan program available. But what's the difference between FHA and conventional?
You know the payment-wise and down payment-wise, they're not too dissimilar. FHA, is 3.5% down. Conventional can be anywhere from 3 to 5% down. So they're in that same general range, depending on, profile and all that kind of stuff. If you're a first-time home buyer, you can do a conventional loan with as little as 3% down. And most people think you need 20% down.
Exactly.
And so at the end of the day, the payments are somewhat similar. Most times when I put people on an FHA loan, it's because their credit scores aren't as good as, they're not in that 680, 700 plus range, and then also if FHA is a little more forgiving for debt ratio. So you're capped at about a 45 to 50% debt ratio. So the amount of money you make versus all your bills in the new house, you can go to 45 or 50%. Whereas in FHA, they'll allow you to go 55. So you got a little bit more buying power there. So if you got some bumps and bruises on your credit and your credit's not quite as good as it should be, or if you're buying right, at a little bit higher limit, then FHA is not a bad product.
Okay.
And payments aren't dissimilar. So it's really helps. It's kind of like almost, I wouldn't call it a second chance loan, but it's a loan that helps that borrower that might not be completely perfect.
Okay. So sometimes they won't have a choice, but if they qualify for conventional, you would put
more times than not, I'd go conventional if they qualify, if they've got great credit. Usually that denominator that place is either debt ratio or credit will dictate where we go.
Debt ratio or credit. So let's talk about some more common questions. A lot of people are asking, hey, can I use gift funds if I want to buy a house? How does that factor in?
There's not a loan product out there that I can think of except if you're buying an investment property where you can't use gift funds. So if you're buying a primary and someone wants to gift you that money, then you can absolutely use those. The best way to use them is to wire them straight to title, because it doesn't create this paper trail that we've got to document. On the conventional side, you can wire straight to title and just have a gift letter. On the FHA side, you would need a bank statement from the person that's gifting that shows that they have the ability to donate, and then you could wire it straight into title. But that keeps that whole trail from getting, hey, I got to get a copy of the check. I got to source it from one bank statement. I got to show it on your bank statement.
Creates more work for you.
It creates more work, but it also creates adding different layers that potentially put more risk in. It's better to keep things simple.
Okay. And added to that, so let's say a couple is going to have $25,000 in gift money. Does that, and let's say you've already approved them for a $400,000 loan, and they say, hey, guess what, Todd? We're going to get $25,000. Now can I buy a $425,000 house?
It doesn't help your debt ratios.
Okay.
But, so it doesn't necessarily, it's not income, right? So if I've got you approved at $400,000, you could, the extra down payment, you could sit there and say, I've got gift funds so I can push my price up, because I could just use that money. Right. Because my taxes and insurance don't change.
Right.
Those are set. So you can get back to a level there, but for the most part, it's more of an asset item, not a debt to income item. So it really doesn't help you with purchasing power unless you're saying, hey, I'm getting a larger down payment so I can buy more house.
Right.
It doesn't necessarily help you. But, you do see that. You see people saying, hey, I need to stretch to 450 and I was at 400. Mom and dad are going to give me 50,000. I'm still going to put my my $10,000 down on my 400 or whatever, my $20,000 down on 400 or whatever.
Right.
You see that, but more times than not, it's people are getting gift funds for down payment and closing costs. They're not necessarily using it to buy more house.
Right. Okay. What about, so again, because of the crazy market, everybody's looking, and interest rates are going up, looking at different options to try and buy a house. So what is your understanding as far as if people want to take money out of their IRA?
You can take money out of a retirement account. There's, rules there, and I would, check with my CPA.
Check with your CPA.
Yeah, absolutely. But my understanding is you can take money from an IRA account, especially if you're 59 and a half, you can take it,
without a penalty.
Without a penalty. You have to pay taxes on it if it's in a traditional IRA, but you can take that money. Also, let's say that you've got a house to sell, okay, and your down payment, you can't get to that money for down payment,
right.
and you needed a little money out of your IRA, you can take money from your IRA account, turn around, sell your house and put that money back within 60 days. And my understanding is you don't have a penalty for that. It's kind of like a non-event as far as the IRS is concerned. So, but there's a lot of little things that you can do, whether it's that or a line of credit against your current house. There's things that you can do to compensate for some of that.
Yeah, we did talk about that the other day, and I've actually had that happen with some other clients of mine. So let's talk about home equity line of credit and how you could use that in this buying situation.
Right. So if let's say that you have a house and let's say it's paid for.
Yeah.
Let's say it's paid for, but you don't have a lot of cash, but you want to set it up so that you can buy the next house, then go sell your house and then move ahead of time and all that kind of stuff, so that you have to just move once, you have to move twice.
Yes,
and all
that's
that
what we all want.
Right. So you can go get a line of credit against that house, use that for your down payment money on the new house, and then when you go to sell your house, you close out the line of credit. And the key is you got to qualify for both loans. You got to qualify for the line of credit, and you've got to qualify for the new loan. And so you got to have enough capacity that you can qualify for both loans.
Right.
But situation by situation, we'll go look at that, whether it's an IRA or a line of credit or whatever, and we'll figure out what makes the most sense.
Okay. So you can help buyers and sellers work through what's going to make the most sense for them.
There's no one approach that works best for any one borrower.
Right.
It's really, you got to understand the puzzle. That's why I like to talk to people, because through that dialogue, you'll get that puzzle pieces together, and you'll say, okay, here's what we can do to make this thing work. And that's the art of this business. If everybody was W-2 making a ton of money and all that stuff, then everything would be easy. But that's not what it is.
Right.
Every loan's unique.
Yes. Kind of like every real estate deal. There is no one size fits all.
Right. You don't know what's going to happen. Right?
No. Right. Which is why you and I like what we're doing. Right. And you briefly touched on this a minute ago, but a lot of people are under the misconception that, hey, I need to put 20% down, and that's not a requirement.
Hear it all the time.
Hear it all the time
that I've got to put 20% down. Even if you watch the news, you'll hear a reporter say you need 20% down. But the reality is that every single product out there is, VA is 100% financing, so you don't need a down payment.
Right.
USDA is 100% financing, you don't need a down payment. FHA's the minimum's 3.5%, and conventional, depending on your profile, is either 3 or 5%.
Okay. So now everybody's, of course, talking about interest rates increasing. We're no longer in the 3s, we're in the 5s, and everybody's a little worried. We don't know what's going to happen. So a lot of my clients are asking, if I sell and I buy something, or if they're just a first-time buyer, what can I do to lock in my interest rate? How does that work?
Usually, most lenders won't lock in a loan until you've got a property. Now, we've got a shop and lock program, but when you start doing the math, it's not as attractive as it could. What I suggest to people is, get that house, and then we'll lock you in. Somewhere in that 30 to 60 day range is usually what we're locking people in for. But that move on rates has already happened. If I was at 3% or buying, and it was going to, I thought, hey, they're going to go up pretty soon, then I would sit there and be worried about that. But in this market with rates already moved, I think we're going to stabilize out somewhere, in this general range. We might go a touch higher, we might go a touch lower. No one knows which way they're going.
Right.
But you're starting to see the market behave a little bit more normally, and what I mean by that is usually when the stock market sells off, rates get a little bit better, and you're starting to see that. Before, hey, the stock market would sell off and rates would get worse, and that's not usually what you see happen. So I think we're starting to stabilize in a range where rates are going to stay in a general range, and I think it's important to people know that your rate's not permanent.
Yes.
The price that you pay for the house is permanent. You can't get away from that. But most people are going to, there's my guess, and it's truly, I don't know, but there'll be an event somewhere down the road, whether it's 3 years or 6 years from now, that drives rates back down again, and you'll have a chance to refinance. And so, you saw it in 2008.
Right.
You saw it in 2020 with COVID.
Yes.
And since I've been in the business, rates, were around 6% when I got in, and they haven't been that high since. And I think we're probably, close to the top, but who knows?
Right.
But you're starting to see things behave a little bit more like you would anticipate they behave. So
that's a good point to everybody that, buy now while you can if you need to buy. And if interest rates should dramatically decrease, you can always refinance, and you'll run the numbers and help
Right.
people decide if that's a good move or not.
Yeah, I think the biggest advice that I can give people is, don't buy your rate down and stuff when rates are at, an all-time high over the last few years. Take the rate that's out there, save your cash, and then when that refinance comes around, then use the money to refinance and get a lower rate.
Okay.
So.
What about people who are self-employed?
Yeah, self-employed's always tricky, and that market's always been underserved a little bit, So some of the programs out there, like if you've been self-employed and you've had the same business for 5 years, then Freddie Mac basically says you can use 1 year's tax returns.
Okay.
When we run it through Fannie Mae's system, a lot of times, depending on the strength of the file, we'll get a feedback that says we need 1 year's tax return. So that allows a self-employed borrower to make sure that if they're going to go buy, that 1 year's tax return looks really good, right?
Right.
They haven't written everything off,
Right.
So the other programs that are starting to come out to serve that market is there's bank statement programs for, whether they're business bank statements or personal bank statements for self-employed borrowers that have been self-employed for 2 years. They can use the cash flow from their bank statements to qualify.
Okay, great. So because there are just, I think since COVID, there are more and more people who are now self-employed.
Yeah.
And wondering, okay, how am I going to do it? I don't have this magical W-2 to show you.
And there's, I think the market, as long as we don't have something that's disruptive,
Right.
that there'll be products that sit there and backfill that space. But you are going to need a certain amount of money down. On the bank statement programs and stuff, you usually need 10 to 20% down,
Okay.
somewhere in there. Whereas if you can qualify on the Fannie side, again, you could get away with 3 or 5%. So they want a little more skin in the game if you're using what's called a bank statement or non-QM product.
Okay, great.
Yeah.
How about for people who have credit issues for various reasons? It could be an old bankruptcy, it could be whatever. What can you do to help people in that situation?
It's interesting, because credit's one of those things that, obviously if I don't have great credit, then they're going to need some advice on what they need to do. And we don't charge for it, and we're not licensed to help with credit, but we've got simulators that we can load a credit report into.
Okay.
And we can sit there and model, hey, if you paid down this card, what will it get you? If you can get this collection off. And we walk customers through that at no charge to help them understand what that looks like. And, so it's not necessarily, hey, I can't buy a house. It's just not right now. Let's go work on this stuff. And I've worked with people for 2 years to get their credit right, and then they finally buy a house. And then some people, hey, it's a pretty simple fix.
Nice.
And then there's also people that have got pretty good credit. They might be sitting at 690, and if they can get to 720, they'll save a quarter point in interest rate, and it's a relatively easy fix. So it's not just for people that have bad credit that we help, but it's also how do we help maximize that rate or get the lowest rate for people that are in different tiers.
Different tiers.
Yeah.
That's awesome.
Yeah.
Obviously you have a lot of success stories with that.
Yeah.
That's wonderful.
Yeah.
Well, is there anything else you think we need to know for 2022 on the mortgage side?
Yeah, I think that I've had a lot of talk with realtors and loan officers and stuff, and I sit there and I go, there's plenty of transactions that are still happening. And sure, some things are harder. If you're on the sales side, things might be a little bit easier. But it's, if everybody just stays focused and patient and works through things, I think that 2020 is going to continue to be a pretty good year. So
all right.
Everything's functioning well right now.
Good.
Yeah.
Well, tell everybody how they can get a hold of you.
Yeah, probably the best way to get a hold of me is just call me.
Okay.
And my cell phone, it's the only number I work off of. It's 817-291-1350.
All right.
Or you can email me and stuff. If you just put my phone number in, you'll find me on the web.
Okay.
So.
And you're here in this wonderful facility here in Colleyville that's just gorgeous. So, and you're happy to meet with people, talk with people, or they can just upload documents if they don't want to talk.
I probably about 10% of my customers I meet with in person, and that's because they want to. And it's not because I'll do what they want to do. Some people want that touch, and then some people say, hey, let's handle it over the phone. But whatever fits you. If you want to do an application over the phone with me, I'm happy to do that. If you want to go online and fill one out, then you're welcome to do that also.
Welcome to do that too.
Yeah.
All right. Well, thanks for your time, and that's what you need to know today with all things mortgage related.
All right.